But in the main, the reports are being quite thin. And in some instances, you feel like that spread through the report and they're not really telling you where to look. So it's almost like they are hiding some of the information.
Welcome to The Greener Way. I'm your host, Michelle Baltazar. And today we're talking climate disclosure and what Australia's new mandatory climate reporting regime, introduced in 2024 with initial reports for calendar year companies due next month, means for investors and the broader market in general. Joining us today is Dr. Mary Stewart, lead partner for corporate sustainability and climate change ANZ at ERM. She is one of the country's leading independent experts on climate risk and disclosure. Mary, welcome to The Greener Way.
Thank you. Thank you very much for the invitation to talk to you today.
Not a problem. I mean, this is quite topical. We're talking about climate risk, but also just the mood and anxiety in the markets in general with what's happening. But very quickly, tell us about ERM.
So ERM is the world's largest pure-play sustainability consultancy. We have around 8,000 consultants around the world, and sustainability and climate change is all that we do.
Let's start with the basics. What are these new mandatory climate disclosures, and why should investors and boards be paying close attention today?
The climate disclosures were a change to the Corporations Act, and they came into the Act about 24 months ago. And so they are applied to all registered companies in Australia over a certain size. Whether you're a listed company or an unlisted company, they are now part of your financial disclosures. And that's why the board should be concerned, because these are being disclosed through the financial reports. Board shouldn't only be concerned, board should also be interested in the fact that there's a whole lot of opportunity that can be seen alongside what risks climate represents to the business model and to the business strategy.
Tell us about that. Are there any specific companies, or how do we know which ones will be reporting?
There's three tranches of reporters, and we call them Group 1, Group 2, and Group 3 reporters. And the Group 1 reporters are the really big companies. So they're $1 billion in assets, 500 million in revenue, or over 1,000 people. So if a company triggers two of those, they are required to disclose. And that is listed or unlisted companies. And it's the unlisted companies that are finding this more of a challenge because they haven't had to do any disclosures before. So as they start to come into the reporting requirements, they are having to uplift quite significantly. So Group 1 reporters are the really big companies, and you have to disclose alongside your financial reports. The information is included in your financial reports. So the first group of companies are the calendar year reporters who finished their calendar year in December last year. And we've seen a couple of the reports coming into the market already as the financial reports are starting to trickle through.
And how would you describe the quality of these financial reports? The few that you've seen, or the few that have reported?
They're always surprising. And everyone's been saying, what does good look like? And people have been putting out templated reports. But really, the templated reports that were put into the market were gold standard. And what we're seeing coming through the reports is the reality of what companies have been asked to do. And recognizing, as I said, there are a whole group of companies that have never disclosed or never gathered this information before. There's been a significant uplift in understanding for them. And I would measure the reports of those companies quite differently to, say, an ASX 200 company who should have been looking at this data for a long time. So what I would see as pretty thin for an ASX 100 company is probably adequate for PE that's never looked at this information before. So with that in the background, I'm going to say that a lot of the reports have been disappointing in their lack of detail. There are some standouts. I'm going to say Rio Tinto's report is what I would expect from a company of that stature.
Mm-hmm.
And they've spent a lot of time thinking through the concepts. But in the main, the reports are being quite thin. And in some instances, you feel like that spread through the report and they're not really telling you where to look. So it's almost like they are hiding some of the information.
All right. I don't like the sound of that, because I'm just about to ask you about corporate transparency. And also, to be fair, 2 years ago, I attended the conference where there was just the new conversations around this mandatory disclosures. And one of the challenges is that, and you can correct me if I'm wrong, there aren't enough experts to do this correctly. So what are the learnings right now, even from the very few that have already reported, for those who are going to report in the coming months?
So I suppose that correctly is a challenging or an interesting question because these reports have been audited. So if they've
Mm,
been audited and they've
yes.
made it past the auditor, they are adequate. And surely that's all we need to aim for is adequate. I don't think that anyone's going to aim for a gold star or I absolutely have to go beyond everything in my disclosures. Everyone should be disclosing what is adequate to meet the needs of their auditors and their investors. So I think that's what we need to keep in mind as we work through this. There's what is adequate for the auditors and what's adequate for the investors. But ultimately, this is about company strategy and your business model and what that needs to look like in 2050 as we head towards this carbon-free economy with a much greater or a greatly changed natural environment. That's what we're aiming at. We're aiming at building the companies that will survive in that future and manage through the uncertainty on the way through. So, yeah, what is good enough? Good enough is what your auditor says is good enough. And really, as we're working through the learning and the challenges of what a report looks like, get your auditor into the room sooner rather than later. Have the conversation with the auditor when you start, not a month before you want the report in the public domain. Talk to them about the choices you're making. Talk to them about the decisions you've taken, about where this sits, how you're informing the data set, and what you're going to ask your board to sign off on, because they will then help you get to the endpoint faster.
And now let's talk about climate risk management and leadership in practice. There's a sense that some CEOs are more involved in terms of this mandatory climate disclosures, while others would leave it to the sustainability team, if you like, to look after. What are your views on this? Are there more CEOs taking this seriously? I know that it's already, we're here, you need to do this. Or is there still a little bit of kind of lethargy in really diving in and doing this right?
So the first observation to make is that we've seen responsibility for these disclosures migrate from sustainability to finance. And the CFOs are definitely taking this seriously because it's going into their financial report. A measure of how seriously is something being taken by the CEOs, it really is a function of what the business does and what the impact looks like. So in that this is a mandatory requirement, all the CEOs we've spoken to are taking this seriously because they have to comply, and they are. But what we're finding, this is the start of a conversation. As we go through Group 1 and Group 2 and Group 3, and as we go through the years of reporting, the detail becomes much greater and the report becomes much richer, and the decisions that you take can become clearer. So we're at the start of that conversation. And as companies move through their maturity and move through pulling the report together, you can start having a different conversation internally about what your disclosure appetite is and what you want to take to your board and what you want to ultimately put out in your financial report. A CEO can't find themselves separate to that conversation.
Mm.
So I think it's more where in that conversation the company finds itself and at what point has it been brought to the CEO and how they're engaging with the disclosure appetite of the board and what ultimately will go into the financial report. I haven't met any that have said, this doesn't impact me at all. I'm standing next to it. As I said, there's different levels of maturity in the conversation in science companies and therefore different engagement with the CEO.
Now let's talk about listed companies. Australia is unique in that it is heavily about the banking and mining sectors. If I think about the climate risk within those sectors, do you anticipate some bad news in the next 8 months about what is happening under the bonnet now that this is now going to be a new world of corporate transparency in terms of climate risk management?
I think it's good news because those risks are there. Whether we look at them or not, those risks are there. Every single entity in Australia and globally faces climate risk. The good news is that we're looking at it and we're trying to work out where the big risks lie and where the addressable risks lie. And importantly, we're working out how businesses need to change so that they can survive this. We're looking at the business opportunity associated with understanding the risk, quantifying the risk, and then addressing it head on. So for me, it's good. Yes, there will be big numbers. The potential impact, particularly of physical risk to business models, is in the trillions. But if we know where the risk is, we have a chance of managing it before it becomes catastrophic and destructive.
I think you've referred to this before we started the podcast as knowable risk. We know that they're there, but now it's out in the open that we can talk about it. But part of me as one of the mom and dad investors out there is that I just see this as seeing all the dirty laundry, if you like, the measures of how bad it is that we haven't really managed the climate risk properly. And therefore, there's an immediate reaction in terms of the share price. So that's bad news to me. But you're saying that there could be short-term pain and long-term gain, or will it be good news at the very outset?
Well, for me, the good news is the transparency. I think that we will have to accept that mostly companies are looking at climate risk. It's a difficult conversation to have to say, there is all of this destruction coming and I see the opportunity in it. It's not an easy one to speak to. But if we manage the risk, we at least shore up our business model. And then if we look for the opportunity that comes with addressing the risk, we build a future-proofed company. So, whenever you make an investment, you take a considered view on how you think the business will fare into the medium term or the long term, depending on how long you want to hold it for. And you take an idea on, you think about the risk associated with that investment and you decide whether you're willing to accept it or not. Now, instead of just looking at what the business model looks like, you will have an additional set of information that says, this is how well this company considers climate risk. Because climate change is inevitable. It will happen. So you will be able to, from looking at how they're talking about their current situation and future situations, understand how well they're managing this knowable risk. And you will be able to take a more considered decision about, this is what they're saying about their future business model. Do I think they're actually going to get there?
And what are they doing about it? Now, as an investor, what are the things that they should look first when all these numbers or reporting's out in market?
From my perspective is, can you find the report? For me, is it hidden all over the place? Have they put a table that says to me very clearly where you can find it, or is it a single section on its own? So are they owning this risk? And then it's we're coming back to this word transparency. It's the clarity with which they explain it. Because I'm not expecting everyone to have deep dive scope 3s. So those are the emissions associated with your supply chain and what happens with your product. And I'm not expecting them to have fully fledged scenario analyses and a full understanding of their climate risk. But explain to me where you think your material scope 3s are and how you're going to go and find out more information and whether it does impact the future longevity of your business. Explain to me how your scenarios have been used to stress test your strategy, how you're going to change your strategy if those scenarios say that you're pointing in a challenging direction relative to what the climate's going to do. So I'm not expecting complete data sets. For me, what would look like adequate management of the risk is people pointing at what they know, what they don't know, and what they're going to do about their gaps.
Mary, thank you for helping us unpack such an important shift in Australia's reporting landscape. Anything else you'd like to share with our listeners before we end this episode?
The one thing that really makes me hold out hope in what we're seeing in Australia at the moment is, because of the scale of the Australian capital market, what the investors are going to see coming out of companies in Australia this year is going to change what they're going to expect from global companies. So whether your company is listed or registered in a country that has a mandatory disclosure or not, the investors are going to start expecting to see information of this breadth and this quality in all of the disclosures globally. So if Australia gets one great year of reporting under its belt, we're going to shift the dial on financial disclosure on a global basis. And for me, that's Australia leading the way. But it's also the disclosures we need to see globally as we head towards a much more uncertain climate future.
Once again, Mary, thank you so much for joining us.
Thanks, Michelle.
And that's The Greener Way. I'm your host, Michelle Baltazar. Thank you for listening.
The Greener Way podcast is a product of FS Sustainability. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional, legal, or tax advice. Before making any financial decisions, you should read the product disclosure statement, and if necessary, consult a licensed financial professional. For more information, head to the disclaimer page on the FS Sustainability website, fssustainability.com.au.